Just a second. Okay. Still saying we're offline on here. Should be showing stream health or something. At this point, I feel like. Yeah? No? Okay. Encoder should be started here. Hmm. It's a bit odd. What's up, Peter? You able to watch this? Are you seeing this, or is this just something on the YouTube end where it's showing that I'm offline still? If you look at the, for some reason it's still looking like I'm offline. Okay, so it is showing up live. Cool, awesome. All right, well, let's go ahead and get started there then. A couple minutes behind, but yeah. So today we're going to be talking about moving average strategies. I've still got some stuff up on my chart, which I'm just going to hide for the sake of the stream here today. Yeah, so we put the poll out earlier in the week. I think it was Wednesday that we put that out, and that was what you guys said you wanted to see, was some moving average strategies. So first off, I'm sure a lot of you guys probably know this already, but we're going to go ahead and start with the basics. There are two kinds of moving averages. So we have, my indicators button's not working. Let's try this. So there's two kinds of moving averages. So there is a simple moving average, which is abbreviated to an SMA, or even just an MA. And then there is an exponential moving average, which is an EMA. And the difference between the two is a moving average is just an average of price on the daily or on the period close of the candle. So if you're on the daily chart, it would be the average daily close price for however many periods you set the length of that moving average to be. So if we have a 10-period moving average, it's going to take the last 10 candle closes and average the price, and then smooth a line between those prices. And that's where we get our moving average from. An exponential moving average is a bit different in that it puts an extra weight. The calculation puts extra weight on more recent candle closes. So it's going to follow price a little bit more closely because of that extra weight. Very, very similar concept though. So, come on, don't do this to me, computer. Apparently my trading view hates me today, so we are going to put both a EMA and an SMA on the chart, just so you can kind of see the difference between the two. So we have, why is this not showing up in the top left hand? There we go. Okay. So So we're going to go ahead and change these so that they're both the same length, so we can kind of see the difference. Let's say 15. Alright. So as you can kind of see, the exponential moving average, the blue one, follows price quite a bit more closely than the simple moving average, even though they're taking the same data set. The calculation is different between both of them. So common moving average strategy is to use the same length on both a simple moving average and an exponential moving average, and then just play crosses of the two. So as you can see, whenever you're using a moving average strategy with two or more, you're going to have a leading moving average, and then you're going to have a lagging moving average. The leading one is the one that responds closest to price, right? And the lagging one is going to be the one that responds, less close. If you're using multiple moving averages, you might have several lagging and several leading. It's the basis of a couple different indicators. But a lot of people will use like 20-period moving averages or 10-period, and then just play crosses. So you would see something like, hey, we're on the 1 hour chart right now. So we see a cross right here where the exponential moving average crosses above. So we would take a long position, and then we'd hang on to that long position until we saw it cross below. So that would have taken us all the way from like right here to right here, and then would have flipped short right here. So that would have been, let's go ahead and measure that out to see how well that would have done this time. And again, I just picked 15 as an example, but it's still kind of the same strategy, regardless of what you choose the value to be. So yeah, so that's a 2.43% increase between those two. About. Probably didn't get that exactly right, but it's a very nifty little, it's a very simple little strategy that a lot of people like to use. So we're going to go ahead and get into another one here that I personally am a fan of, and that is, it's just the one moving average. It's the exponential moving average. It's the 21 period, and this works on all time frames. But I feel like the 21 period moving average follows price closely enough that it signals a bunch of noise, so you can get a cross above or below, and it doesn't necessarily mean that price is going to drop or rise, but you never run into any times when price is going, is making massive moves away from it. So if you see price above the 21 period moving average, you'd feel a lot more comfortable taking it long, because there's not a whole lot of room for it to go in the opposite direction. So you don't see these massive swings. Like the difference between the farthest away it ever got from the moving average right here is still like 0.5%, something around that line. Take that. It's hard to see. So that's about 1%. Somewhere around there, a little under. So I like the 21 period moving average just as a general indicator. Once you get into higher time frames, it actually becomes a decent indicator of its own. If you would have followed only the 21 period moving average since the beginning of the year, taking a long when price was above it, taking a short when price was below it, you would have actually done pretty well for yourself. You would have made a decent amount of money. I did the math a while ago, but this was back in like June, so I don't have an updated number for you, but I do remember that it was quite profitable. So on higher time frames, this is actually a very decent trading strategy of its own, and it's very, very simple. It's very visual. A lot of people like that. So you can see, okay, it's, hey, price is above the EMA, I know I'm supposed to long, right? Super simple, super easy. Is it the most efficient trading strategy? Absolutely not. But does it work? Yes. And again, that's on the daily time frame and higher. So I'm gonna check to see if you guys have questions or anything real quick. Okay. What's up, guys? Yeah, so let's get into some more complex stuff here. So we're going to get rid of this exponential moving average. So one of the most common that people like to use is a moving average strategy of 10 and 20 period moving averages. You guys have probably seen people using these before, and that is because, oh, I'm going to change this one so it's a different color. 1 second. There we go. And that is because it's super simple and it works. So as you can see, I have the 10 period moving average and the 20 period moving average. This one works on all time frames. Let's go ahead and drop down to the 15-minute or something. Now the lower time frame, the more noise you're going to get, or the more false signals, but it's still a profitable strategy. So as you can see, this is going to work best in markets that with a decent amount of motion. It's not going to be something you want to use in a ranging or choppy market, so it's not quite so great here. If you're in a ranging or choppy market, you just want to zoom out as far as time frame goes. But overall, not too bad. You can kind of see how performance would track here. You know, it catches all the big moves there, and for most of them, you know, you set limit orders, and you'll stop out without a huge amount of loss. It's just kind of a pain resetting it every time you see it cross. But so zoom back out here again. The primary thing you're looking for in a moving average strategy, you want to know which moving average is the leading and which one is the lagging. You want to use that so that you're going to follow price in the direction of the leading indicator crossing the lagging indicator. So 10 and 20 period moving average, very popular, does a great job. Can be used as a good scalping tool, but again, not in so much in raging markets. So you have 4 hours. You know, you can catch these. You can catch some of these swings. You do pretty well. 3% swing there. You have the previous move was. I'm on magnet mode. That's why. Previous move. 5%, get, no, 2.3%. So you can catch these moves pretty well just by using a 10 and 20 period moving average. And the higher the time frame on any moving average strategy, the stronger the signal and the less likely you are to get noise. You know, where you just see coiling, where it's just kind of sideways action. You get a bunch of crosses of the moving averages, but no real action, right? So the higher time frame you trade on, the more you tend to avoid that. Doesn't mean you can't use it on lower time frames, because it still works. You'll just get a lot of signals that, you know, that if you enter the trade there, you'll just break even. So, so moving average strategies are definitely work a little better on higher time frames. So, I mean, yeah, you zoom out to like the daily chart, and it just becomes stupid how much money you can make with this. So you catch everything from here to here. That's actually not that massive of a move, but the next one, yeah. If you would have been following this strategy, I think the biggest move you would have made all year would have been like a 40% swing in what? How long is that? That's about a month and a half, right? Yeah, about 5 weeks. And that's, you know, without any leverage applied or anything like that. So very, very effective. Especially if you decide to combine it with something like a trailing stop loss. I realize that's only available really on BitMEX right now, so it's not something that a lot of you really like to mess with. But if you happen to have a platform that enables trailing stop losses with a moving average strategy, it can be very, very strong. So yeah, so that is the 10 and 20 period moving average. Now let's talk about crosses. So golden cross and death cross. You guys might have heard these terms before, and I will show you where they come from. Actually, what am I doing? They come from a moving average strategy that came from traditional markets, so like the stock market, options, forex, stuff like that. And that is most traditional markets. The standard quote-unquote moving average setup is going to be the 50, 100, and 200 period moving averages, and it's almost always on the daily chart. Okay, because in a lot of traditional markets, you don't get these wild swings. Everybody trades on the daily because that's the only place you really see massive motion. So again, I'm going to change the colors of these so you can see what we're talking about. So our 50 period is going to be yellow. Our 100 period is going to be red, and our 200 period will be blue. So as you can see, there's some significant gaps between these moving averages. Now, we would see the yellow cross the red not until like 12,000 after the peak, right? And the yellow doesn't cross the blue until about 9,300, or that's the price at which they cross. But the actual price of the asset at the time is all the way down to close to the bottom at 7,000 or so. So you're not so much looking for a cross as to tell you when to sell, per se. Again, this has more space, so it doesn't provide nearly as many crosses, which means when it does, it's not nearly as accurate. You're not going to make such large gains off of following it, but it is a relatively strong trend indicator. So you can see, hey, we have plenty of space between each three. They're all kind of increasing at the same rate, the same proportion for the most part. The 50 period is a little bit more sensitive than some of the others. But, overall they're kind of increasing at the same rate. And let's go ahead and actually go to the next so we can see some longer history. There we go. So, you have all this history where we can kind of see it. But what we're looking for is what's called a golden cross or a death cross. So a golden cross is when we have the 50 period moving average on the daily chart cross the 200 period moving average, right? And that is considered in traditional markets to be a strong indicator of continued bullish or bearish momentum. Now, it takes quite a bit of momentum to get to that point to begin with, right? Because normally these moving averages are spaced out very well already because they're on such a massive time frame. But if you do manage to get across, it's not a common thing. The idea is that the momentum is probably significant enough that it's not just a correction, right? You're looking at a full-on bear market. So you can kind of see that here where we get our bear cross, our death cross in 08 of April, so 2014. Now we do end up coming up to get a golden cross, which is a cross to the positive, back in July, so a couple months later, but it doesn't last very long. It lasts from July to mid-August or early September, and then we get a death cross again, and we see continued motion all the way through, all the way through the year after that. So for about 8 months after that, we see a bear market. Then we get a golden cross again, and again it doesn't last very long. It kind of wobbles around a little bit here, but then when it crosses again, bullishly, that's around the first second of November 2015. We don't see another bear cross until the most recent one. We don't see another death cross until, I think that's like 31st of March of this year, right? So, fairly decent indicator if you are an investor. I'm talking to somebody who's not looking at trading every day, not looking at constantly buying or selling, who picks based on fundamentals but wants to have an idea of the technical analysis. This is an excellent tool. Highly recommend just putting these three moving averages on your chart and using them to kind of check your investment. So if you see a death cross, it might be worth exiting your position because there's a good chance you'll be able to enter it again lower. Yeah. Now you see if you've been eyeing an asset and you think, hey, I think I might want to buy this, and you see a golden cross, that 50 comes up over the 200 period moving average, then yeah, might be a good time to take a second look at it and think about actually getting in. But that would be my 2 cents on it. Yeah, definitely a more long-term tool, but it's still something that I get questions about every once in a while. So let's see. Who is running the stream? I don't recognize the voice. This is iDrawCharts. My name's David. You guys having sound issues? There's not really any background noise, but except maybe my computer fan. I'll have to go back and rewatch the stream, see if I'm having audio issues. Okay, so let's see. So those are the primary moving average strategies that I use. Is the 10 and 20 cross, the 21 period exponential moving average, and then the 50, 100, and 200 moving average on the daily chart. Now you can use the 50, 100, and 200 on any other chart you want, but traditionally speaking, it's been a daily chart indicator. So I typically tend to keep it that way. Let's see. So some other moving average strategies that are, or indicators that are based off of moving averages. I think the most well-known is probably Bollinger Bands. So Bollinger Bands, believe it or not, is actually a moving average strategy. And so you see the middle line, which is a dark red here. You can adjust the length, so you can have it be a 60 period moving average, which is going to significantly decrease the responsiveness of it. Or I think the default is 20 period. So, and then the outer bands are almost like a moving average of volatility, or the average volatile range. So, but it is a moving average strategy. So that one's a bit more complex, but it does use moving averages as the basis for your indicator. Other moving average strategies include the Alligator, which is basically just a crap ton of moving averages. Right, so you see, hey, let me close these out here so you can see just the Alligator. This is the Alligator. It's 3 moving averages. You have a 13, 8, and a 5, and you're basically looking at like you would any other moving average strategy. You're just looking for crosses on either side. So that one is very obviously moving average based. Then one that a lot of people don't really think about or know is the Ichimoku cloud is actually a moving average strategy. And this one is a bit more complex looking. I'm sure you guys have seen people with it on their charts before. It works very well. The way this one works is by adjusting left and right, where the moving average falls on the chart, as well as reducing smoothing. So you don't see those rounded edges like you do a lot of times on other moving averages, where everything looks super smooth. You see these kind of jagged edges, everything's kind of squiggly. That's because the math used to generate these does not include a rounding formula, which can be very useful sometimes. It's much better for identifying support and resistance levels and things like that. But it is a moving average based indicator. So you have the cloud, you have the Kaijin span, Tinku span. Anyway, yeah, I'm working on a course right now that includes that'll kind of give you guys a breakdown of the Ichimoku cloud and how to use it. Because it's one of those indicators that looks super fancy and everybody wants to use it. I don't know why. A lot of times the simpler stuff is the best, but everybody's just got their own personal things they like using. So, okay, my audio is okay. This mic picks up a lot of noise from the computer's fans. Okay, I'm wondering then if somehow my headset is not working very well, because my headset's usually not that bad in that area. But I'll look into it for sure. Thanks for telling me. I appreciate that. Right. Then other moving average strategies. I'm trying to think. Not a whole lot of them that I can think of. I'm sure there are plenty that are you can find here, but those are kind of the most popular ones. So that was the Williams Alligator. I guess that's that doesn't actually show any of them. Alright, so that's kind of the basics of moving average strategies. Do you guys have any questions? What are you guys thinking? Just gonna wait and see if we have any questions here. It's still showing as offline for me for some reason, so I can't see, you know, how many people we have in here or anything like that. Yeah, it could be something like that. I'm using some kind of pre-scheduler for this thing, which I don't have any experience for before, so maybe should have been selected ahead of time. I'll tell you what's best to use for day trading. Yes, so for day trading, you can use moving average strategies. They're not my favorite, but let's go ahead and take a look at. I assume for day trading, you're talking like, you know, trading on like the 15-minute chart, maybe the 30-minute chart, right? Something along those lines would be my guess. Personally, I would prefer to use the 21 period EMA, but that is a bit more subjective. So, you know, you'll want to combine this with other indicators such as support and resistance levels, things like that. But for the 21 period EMA, often price likes to pull back to it before continuing on a downtrend or an uptrend. You know, any kind of trend, as long as the market is trending, you can use this. So, you know, if you're on the 15-minute chart, say, let's just go way back here where I haven't really looked at it. So, okay. So let's start here with this giant spike. Okay, so we see the giant spike, we're like, okay, whoops. Things are happening in the market. So we're now above, we're now below, we're kind of just watching this float. So our last major motion was upwards, but we're not really seeing a large trend, right? We're looking for potential trades. We don't really see one. Now, about here, yes, we get a pullback, but we can kind of say, okay, so it looks like, you know, we're kind of getting this uptrend, right? There's not really a solid trend line, but we can see the general motion is sort of upwards. So we may or may not, you know, once we see this, we saw a little bit of a volume spike there, but we're not seeing much downward volume here, right? Now we come back down. There's not a lot of volume on it. So as soon as we start seeing a little bit of volume pick up again, and we're above that trend line, we take a long, right? We'd want to pair it probably with a trailing stop. You know, depending on how volatile the market is at the time, would decide how far away that stop goes. So we say, okay, so we've been confined to a, you know, like a $30 range, so we'd put a $30 trailing stop. So we'd take a long, you know, probably like somewhere right around here, at 6377 or 78. Let's just say 6380, right? Make it nice and round. And then our trailing stop was by $30, so it starts off at 6350. We get all the way up to here. We have 6456, and at 6426 we would stop out. So we would stop out right around like there. So we caught, you know, from here to there. It's a small move, but it's an intraday move. That's kind of what you're looking for. Now here, you could say, okay, we're seeing a spike in sell volume. You may or may not take this short here. That's not very big. You probably wouldn't get a whole lot out of that. You might stop out at break even, or you might even lose a little bit on that. Which is why moving averages for day trading specifically, not my favorite tool. They work, but they're not my favorite tool. But you kind of get the idea of how to use the 21 period exponential moving average. That's my favorite way to use it. Now, if you wanted to do something like a moving average cross strategy, day trading, my recommendation would be the 10 and 20. So I would do something like this. So this is going to provide you a bit more easy to read signals, but again, personally, I would use them with you know, like with tighter trailing stops, because there's a good chance, you know, you're just going to get a whole lot of noise, right? So like right here, we're going to have a bunch of crosses and absolutely no motion. It doesn't really work very well in a sideways or not trending market. Now if the market's trending up, then yeah, I mean it works pretty well. So let's take the most recent example. We have a downtrending market. It works pretty decently. Pair it with a trailing stop. You know, you see, okay, we have a cross. Cross is on that yellow candle. We take a short, right? We take a trailing stop on it, and you know, let's see. Previous range was $10. Let's say $10, $15. So we take a, you know, we sell at, say halfway through this, 558. No, 6558 with a $15 trailing stop. We get all the way down to 497. So like then we come back up and we'd stop out like right around here, right? That's a pretty decent move. You know, that's about a 1% move. That's not bad for intraday trading. Then you see our cross. We see our cross happens again here, and then here. So we wouldn't get any sort of good trade out of that little area right there. We might get a little bit of something right here before it immediately tanks again. Now this one's kind of sucks because we get a cross here on this down candle, and that's kind of what sucks about the moving average strategies. Half the time you don't get a sell or buy trigger until halfway through the move, right? Which is why they're so much more reliable on higher time frames, because the move tends to be more sustained. But yeah, so at some point in this candle, and we don't know when that is, could be all the way down here, we see that moving average cross. We're like, okay, so we sell. So let's say we get it about halfway through. You know, we have 6513 to 6495 is when the next cross happens. Not a big trade. Probably doesn't cover your fees, right? Moving average strategies, to me personally, some people do use them intraday. But for me, they're not worth it. It's a lot of time just playing the various crosses, watching, you know, oh, it crossed here again. Odds are you'll see a cross and it won't make you any money. It is the odd exception. You can make money with that. But it's more about tight management of your risk and your stop losses than it is using the moving average to create trading opportunities for you. In my opinion, there are better ways to do that. So, does that answer your question? How do I know which is the leading and which is the lagging on the 10-20? So the shorter number the smaller number is always going to be the leading indicator. But the easiest way to tell is, all right, so say we have, you know, the easiest one to tell is, okay, which one follows price the closest? So we see the blue line follows price closer, right? It's closer to the actual price than the red one is. It crosses up. That means that it's the leading indicator, right? It follows price closest, and so we're looking at that one to signal based on what it does versus the other one, and it'll always be because it's the smallest value. You know, in this example, we have the 10 and the 20 period moving averages. We have the blue, which is the 10, and the red, which is the 20. It's always going to be whichever one is the lower value of the set of moving averages you're using. So, just did. Thanks a lot. Awesome. Glad to hear. This is kind of bothering me. This audio. I'm feeling kind of self-conscious about it now. I wish I could see what was going on and fix it midstream. How well do 10 and 20 works on 4-hour or 6-hour charts? Works a lot better. A lot better. I don't have the 6-hour on my chart here. It's kind of nasty. So the 10 and 20 works quite well on the 4-hour. So especially in markets that are trending, you know, again, any sort of ranging market is not when moving averages shine the best, but they work pretty decently in trending markets. So let's take an example here. So say we did that. So we got a cross right here. If we just trade from cross to cross, right, looking at 3% there, you know, 3.5%, then we'd short. Actually, I'm not sure if that was an actual cross or if that just came out of touch. Can't quite tell. Zoom in. Doesn't even look like that was a cross. It didn't cross till right here. So that would actually be a smaller percentage because cross slope right there. So okay, so 1.66% there. And then you have it cross back above somewhere on here. So we're going to go right there. 1.25%. And yeah, you could have shorted from here, but my personal common sense would be, okay, it still looks like we're in an uptrend and we're just kind of pausing. I'm not sure if I want to short, but that would just have been me. And I'm also looking at it from hindsight, so I can't say that that's exactly what I would have done. But okay, then we have a short from, here's the cross somewhere in here, so we'll take it from here to this next cross down here. So that's a 5.3% gain that you would have made. Then this is one of those where you're super happy about it, and it's one of the big winners because you go from, you make a ton of money on this one. You make like 19%. Then you get, you could short here again if you wanted to. You wouldn't really get anything out of that. You might lose a little bit. And then again, this one crosses on here, so make like another 6%. So yeah, I mean, overall, the main enemy of a moving average strategy is just when markets aren't moving. So that's when we see like these break-even trades or these little areas where you wouldn't want to do anything because the market's not doing anything. You're not seeing a trend, right? But yeah, on the 4-hour chart, it works pretty well. I don't have the 6-hour one put on my chart. I suppose I could, but overall, works quite well. There's a reason it's a very well-known and popular strategy because it works. And then you combine stuff like a trailing stop, so that you might hey, say, let's see, what was our example? Oh yeah, so you would take the trade starting here, and it got all the way up to here, but didn't actually close out till down here, right? Well, your trailing stop would have cut you off somewhere in the middle. You would have protected those profits. Now, it could have also cut you off early in the trade, which is the thing you don't want to have happen. But come on, load. There we go. For example, during that massive bull run upwards last year, you had times where you would get something like, hey, here's our cross, and we're going to carry it all the way up to like right here. But the difference between 14,000 and 17,000 is quite a bit, right? So you would set a stop loss of like, or a trailing stop loss of like $1,000 when you're down here, right? So, and that's actually just about right. I usually use a trailing stop loss around, if I'm trading on like the 4-hour or higher, it's usually going to be like around a 10% value of the current price. So if the current price is $10,000, my trailing stop loss is going to be $1,000. The current price of whatever I'm trading is $105. My trailing stop loss is going to be around $10 value, right? So that's kind of a rule of thumb. Let's see. How do you prefer MAs over Fib? Yes and no. I like both. Fibonacci is a fantastic tool. I would have to say I probably prefer Fibonacci's to trend or to moving averages, and that's because I'm not a trend trader. I am a horizontals trader. So I like trying to catch tops and bottoms. I like trying to catch wicks, and that's just my personal trading style. The way I like to do it. Fibonacci tends to be a better tool for that. You're not establishing levels by using moving averages, but you are establishing trends. They are a trend indicator, and they're a very good one. I'm just not a trend trader. So it's not that they're a bad indicator, it's just that they don't fit my personal trading strategy super well. But trend trading is one of the easiest ways to learn to trade and to become profitable as you kind of learn about trading. And still one of the most successful trading strategies as a whole. So that's why I talk so much about it, because it's very easy for somebody to grab a hold of and to make, to create a winning strategy for themselves with. Alright. So, I'm not sure. But yeah, so let me see. Trying to think of other moving average strategy or moving average indicators. MA cross. I wonder what this one has built into it. I mean, that's obviously a moving average strategy of some kind, right? Okay, so these guys are using so they're using a 9 period and a 21 period moving average. So it's very, very similar to, you know, the 10 and 20, but not. Okay, so it looks like actually this 21 period is just a regular moving average, and the 9 is an exponential, maybe. I'm not sure. It's hard to tell. But yeah, I mean the thing is, like, you can tweak the lengths of the averages and whether they're simple moving averages or exponential moving averages, and figure out what works best for you. You know, depending on your time frame. On a lower time frame, it's kind of hard to use moving average strategies, but on a higher time frame, you might be able to tweak one, and they're really easy to backtest because they're going to look the same regardless, right? So you can look and say, hey, this is what the moving average looks like. Look for the crosses and just do the math. So it crossed when price was, you know, and you would just take like the middle of the bar as your data point. Say, okay, so 6517 to, you know, let's see, to 7897. You do the math, you'd figure out what the difference is between that, and then you'd do the percentage. And you'd average it out per how many trades, you know, were signaled by the strategy versus how many were profitable and how much you would have made from it. And then you would, you know, say, okay, I think I could get a better result if I brought this, you know, 10 period moving average down to like an 8 period. So then you can make that change, and then you go back and backtest it. You go back and look and see and compare your data points and say, okay, well, it actually ended up working better when it was the 10, you know, or it works better when it was the 8. But it's super easy to see and compare and refine that strategy for yourself. So depending on what time frames you trade on and what asset it is, because it's going to be different on various assets as well. But so alrighty. Well, I'm not seeing a whole lot more questions in there, so I'm going to give it another minute or two. Then I'm going to go ahead and end the stream, I think. So yeah, if you guys got questions, got anything else, let me know real quick, and I will answer them for you. But otherwise, thanks for watching. Alright. I realize actually the stream is quite a bit behind where I am as far as time goes, so I'll give it another half second. Getting a Steam notification of some kind from Yoda. But yeah, I mean, moving average strategies, the key takeaways, you're looking for crosses. They work best on higher time frame charts, and when used correctly, they can be very profitable. That's really the main things you're kind of needing to know. So, hope you guys got a pretty decent idea of, you know, how they work, some of the common setups that people like to use, and yeah, everything else. Alrighty. Well, thanks for tuning in, guys. I appreciate it, and I will see you again. We're going to be doing more of these. We're going to be doing these every week. So I'll be seeing a lot more of you guys, and I will try to make sure that I will double check my audio, make sure we're not getting vacuum cleaner sounds in the stream. So again, thank you guys for watching, and I will see you later.